Thank you for watching this preview video at XM.com. We'll be discussing the upcoming Fed meeting and the outlook for the dollar. I'm Maria Pachortiz, and joining me is Senior Investment Analyst Marios Hadjikyriacos. So Marios, back in December, the Fed signaled 3 quarter-point rate cuts for this year. But given that inflation has been hotter than anticipated over the past few months, do you think there will be a change to the dot plot? What are we likely to hear from Chairman Powell during his press conference on Wednesday?
Hello, Maria. I think there's a good chance we see a change in the dot plot, and let's explain why. So, as you already alluded to, when the Fed met back in December, they signaled 3 rate cuts for this year, under the assumption that inflation was going to come down, that the economy was going to slow down. Now, fast forward 3 months, and what we've seen is the US economy being much more resilient than anyone expected. Economic growth is running around 2.5% for this quarter. The labor market is still in pretty good shape. Of course, supporting everything are tremendous amounts of government spending and solid consumer demand. And as a result of all of this, inflation has been running persistently hot in recent months. We've seen investors unwinding bets of Fed rate cuts. We started the year with the market pricing in about 6 rate cuts from the Fed, and now with the data being so resilient, the market has brought that down to 3 rate cuts, essentially coming around to what the Fed signaled back in December. Now the question is the Fed going to go one step further this time and signal just 2 rate cuts for this year, given how strong the economy has been recently? And I think that there's a pretty good chance that happens, considering the strength in the economic data, and also considering that it wouldn't take a lot, it would only take a few policymakers adjusting their dots for the entire dot plot to shift higher and for the Fed to signal just 2 cuts for this year.
So taking all this into consideration, what reaction might we see in the dollar? What does the greenback need to stage a sustainable rally?
Yeah, so look, we're going to get the dot plot tomorrow. If it points to 2 rate cuts, so if the Fed signals that interest rates are going to stay higher for slightly longer, that's usually a good signal for the dollar. That could benefit the dollar on the expectation of rates staying higher for a bit longer. By the same logic, it might be slightly negative for interest rate sensitive assets like gold or the stock market, for example. So I see some scope for a dollar positive, gold negative reaction, but I want to stress, Maria, this is unlikely to be a massive reaction. Investors already know that interest rates are going to come down. That it's just a matter of time until interest rates come down, even if the Fed pushes the timeline back a little bit. So what's the bigger story for the dollar? Well, the dollar is the second best performing currency of this year, but I find that a bit strange considering that the US economy is much stronger than any of its competitors. So if we were just trading economic fundamentals, you would expect the dollar to be rallying very substantially, and it's not. It's had a decent performance, but nothing too dramatic. One reason for this lacklusterness, for this inability of the dollar to rally, Maria, I think is the stock market. The dollar is a safe haven asset. When the stock market hits new record high after new record high, that diminishes demand for safe havens like the dollar. So for the dollar to stage a sustainable rally, I think that what we need to see is a correction in the stock market, a sell-off. And if that happens to coincide with a deteriorating economic outlook in other economies, especially Europe, that would be the dream scenario for the US dollar.
Marios, thanks so much. This was a preview video here at XM.com.